Welcome back. The House Financial Services Committee issuing a 53-page final staff report on how the Biden administration debanked digital assets. It details how Biden-era regulators used vague rules, excessive discretion, informal guidance, and aggressive enforcement, all to pressure banks into distancing themselves from digital asset clients. This resulted in at least 30 entities or individuals losing access to financial services. Joining me now is Arkansas Congressman French Hill. He is the chairman of the House Financial Services Committee. Mr. Chairman, great to see you this morning. Thanks very much for being here. I want to kick it off with your report. What can you tell us?
Well, Maria, happy holidays. Great to be with you. Hope you had a great Thanksgiving. This report identifies all the ways, led by Gary Gensler, who was chairman of the SEC, the bank supervisors led by Michael Barr, then vice chairman of the Fed, and others, to systematically debank legal businesses in the United States engaged in the digital asset innovative space. And this was terrible for American competitiveness, and it led me during the course of the Biden administration to offer my Fit 21 bill, which is now the Clarity Act, which gives the rules of the road, clear market structure road rules, so that people know how to innovate. They can count on the federal government for not debanking them and actually encouraging the use of innovation blockchain technology inside financial services.
But why would the administration, the Biden administration, want to de-emphasize this?
Well, I think they took the same approach that the Obama administration is, that when they, in their privileged point of view, believes that somehow that this innovation is a bad thing, they wanted to see it blocked from access to the financial system. We call it Chokepoint 2.0. Chokepoint 1.0, led by the FDIC, principally during the Obama administration, encouraged banks through leverage, intimidation, guidance, verbal communication, email listing, to ban them from banking businesses that the Obama administration didn't favor, like gun dealers, for example.
I see.
And this is wrong when the federal government uses its authority to tell a private entity they can or cannot do business with someone just because of their a belief system that, doing business with a gun dealer is bad, doing business with an energy producer is bad because of the climate.
Well, this is a very good point, and it's obviously not what any of the voters or audience wants to see. They want to have their options open. Of course, it's a new day at the Securities and Exchange Commission with Paul Atkins at the chairman's role. I spoke with him yesterday on the floor of the New York Stock Exchange about now a new direction, and that is tokenization. Here's what he said. Watch. The idea of tokenization and having investors own tokens of a larger blueprint of a company. Explain that to us. Where is this going, and what is tokenization?
Tokenization is the idea of using then smart contracts or tokens on-chain to be able to, that represent, say, an underlying security. And so then that tokenized security is a security and would be subject to SEC rules by law. But the idea is that if it's on-chain, on a blockchain, then there's much more transparency as to where it is. Right now there's a bit of opacity as to, who owns what, and where the company usually doesn't even know where its who its shareholders are, and where the shareholders reside, where the shares reside. So tokenization has the benefit of potentially having, instead of T+1 now trade date +1 for clearance and settlement.
Do you expect this is where financial services is going? Are the major banks and the brokers out there today moving increasingly toward tokenization?
Oh, absolutely. And it's the way the world will be.
Your reaction to tokenization, Mr. Chairman?
Well, Maria, tokenization has a lot of benefits. The idea of a smart contract would allow people to lower costs, lower agency costs, have more transparency, have settlement time periods that are broader than what we have in the markets today. And that's why you see the attraction to dollar-backed stablecoins for the same reason on a cash-type transaction. But I think the best place for tokenization to start is in low volume, expensive, high agency cost transactions like the 144A debt market, loan participations, the foreign some foreign exchange transactions, accounts receivable and payable. These can be programmed in a time frame that doesn't require instantaneous transaction times or instantaneous settlement, but it has all the benefits of the documentation that you get with a smart contract. And yes, I think the big companies and big brokers and clearing agents are experimenting with tokenization and see how it compares to the existing digital system that we have now for settlement. And look, Paul Atkins is doing an excellent job at the SEC. We look forward in the coming days in the House under Ann Wagner's leadership, our Capital Markets Subcommittee chair, to bring some capital formation bills that will lower the cost of being a public company. He told you in his interview, we have 50% fewer companies that are public in this country than when Paul and I were graduating from school. We need more opportunities for Americans to invest in, more opportunities for employers and employees to build long-term net worth through the public markets, and we're committed to being his partner here in the House Financial Services Committee.
There's also a totally new environment for the banks with Paul Atkins in charge. I mean, you had that testimony this week from House Financial Services Fed Chair in your committee, the Fed Chair Mickey Bowman, Comptroller Jonathan Gould, and Acting FDIC Chair Travis Hill. What did you take away from that hearing?
We're laser focused on lowering the cost and distractions of the way the Biden administration supervised our financial institutions and broker dealers. They were distracted by things like climate-only policy, DEI policies. And we heard from Mickey Bowman, our new vice chairman of the Federal Reserve, that our bank supervisors are focused on safety and soundness. They're focusing on tailoring their rules based on a company's size, its complexity, its risk. And that's exactly the theme that House Republicans have led on. We think that balances the safety and sounding, stability responsibilities of the supervisors with promoting economic growth and capital that we need in our communities for new homes and for new businesses.
Real quick before you go, Congressman, will we see any change in the Obamacare subsidies, or will those just expire at year end?
Look, I think there's a good faith effort in both the House and Senate to find a path that produces more consumer choice, more competition in health care, more transparency in health care prices. This is something that Congress has struggled with since Obamacare was created back in 2010, and we're going to keep in that fight for more transparency and more affordability for our families.
All right, Congressman, we'll be watching your work, of course.
Great
Thanks
to be
very
with
much.
You.